My name is Evan Manship with Mainstay Property Group. I'm joined here with my close friend, Mr. Finance of America, Jared Shore. We're at his lovely office and bourbon tasting studio in Noblesville, Indiana. Jared,
Yeah.
good to see you again, pal.
Yeah. Cheers, man.
Cheers. What's been happening?
No, just lots of things. Lots of things happening. Market's changing. Just happy to be here.
The loan world is quite the busy place, especially nowadays. Market's gone mad, which means you've gone mad. So happy to catch you in.
Yeah. You caught me on a day where I'm not talking to any of these guys watching.
We're happy to have you here, guys. This is a very, very informal, in case you can't tell, question and answers. Chance for you guys to really reach out and bug us with as many questions as you have regarding finance specifically. Jared works with dozens and dozens and dozens of Mainstay clients to work on recapitalizing their assets and making sure that they're making the most out of the money that they have locked up or playing around with getting financed one way or another. So we have a handful of questions that we'll start out with that have been asked on our Facebook page and on our Google Forms. Just to get everything started, but feel free, smash the like button, smash the share button, and let everyone know this is going on. And feel free to chime in with your questions, comments, concerns at any given point so that we can get them answered for you here with Jared while we got him in the same room for once. So nobody better complain that you can't get Jared on the phone. Right. This is your chance right here. Jared, our first question, and you have to forgive me, I'm not sure who exactly this came from here. Someone's asking about taking a loan and I assume collateralizing it with their cash value, the cash value of their life policy. Can you speak to if that affects the debt to income ratio at all on that person?
Oh man.
Or is that a little bit above the pay grade?
No. So ask the question again. And I haven't read any of these questions yet. So
I should preface here. Jared has not seen these at all, and I wanted to kind of catch him off guard because I want these to be as candid as possible. No one gets anything done on YouTube videos where they're all teed up easy questions to answer. So
I'm assuming if I understand the question correctly, they're taking cash out of a life insurance policy to use it to leverage and buy properties.
Verbatim, if I take out a loan from my cash value life policy, how does it affect my debt to income ratio, if at all?
It's a good question. So
do you see investors doing that very frequently?
No, I would say that's a rare. I mean, people, anybody that has cash, right now, if you can pull cash from anywhere, it's a good thing, right? Cash is king. So it would really depend on one of two things, right? One, it would depend on if you're doing a conventional loan or if you're doing an LLC loan. If it's an LLC loan, we don't care. As long as we can source where that money's coming from, we don't use personal assets, we don't use we don't use personal income, or we don't use a debt to income ratio on the LLC side of lending. It's all debt service ratio stuff. So on that side of things, you're golden.
Got it.
The only time it would affect you if you're doing a conventional loan would be if you actually took a debt out. For example, let's say you took a loan out against your 401k, right? And you have to pay that back, and usually that happens on your paycheck. So if you're paying back a debt that you took out, then it could potentially affect you. We would just take your monthly payment and add that into your debt to income.
Got it. So I guess the piece to take away from that is if you're doing a commercial loan, and commercial loans don't need to be on commercial assets, guys.
Right.
You can get a LLC loan or a commercial loan. They're synonymous on a single family property.
Sure.
To my understanding, what Jared is saying is if you were to do a commercial loan, then these little weird one-off things about your DTI makes less than no difference with what you have going on.
It's more so about where that money came from to buy the property. As long as it's coming from your money, then you're golden.
Jared will take your money whenever you'd like to give it to him.
Yes.
And that's something that Finance of America does, right? I mean, you guys can do these portfolio loans.
We can do both of them. Yep,
okay.
Any side.
Do you want to speak to that a little bit? I guess what people are normally doing, or
yeah. So I think one of the unique things about where I stand with Finance of America, I love this. We got cameras all over the place in here. It's great.
Two ugly guys too up here. You think
they could have picked prettier people.
Good joke.
But we'll take what we can get. Is I can do conventional and LLC loans. So we have a mortgage side and we have a commercial side. So it really allows us to kind of play, right, and utilize both sides. That says, hey, if this doesn't work, we have this that can work. Fix and flip line of credits, refinances, portfolio loans on the LLC side. purchases, refinances, and actually some rehab loans on the conventional side as well. So lots of options. Kind of try to be as much of a one-stop shop as we can.
Well, I can tell you it's the nicest thing in the world. Coming from a one-stop shop, it's nice when you have someone that can speak all the different languages, as opposed to here's what we do. We wholesale houses and that's it, or here we do conventional stuff and that's it. It's nice from an investor perspective to be able to go speak all the different languages. So I can appreciate that, as can many folks watching. All right, this is a good one. This came from an investor in California that would like to remain unnamed, I believe. For a new investor in California, is it worth setting up an LLC attempting a rate and term refi? There's a lot going on with this question, so I'm going to make sure I ask it. For a new investor in California, is it worth setting up an LLC and attempting a rate and term refi for a first BRRRR project to bypass the conventional 6-month seasoning period?
Yeah.
Or would you recommend doing a normal cash-out refi with a 6-month seasoning period to gain experience on the front end? I know this has been a big hot-ticket item for you and I, so I'll let you have the floor.
So it's a loaded question, right? Every scenario is a little different. I can tell you the easiest thing to do is going to be wait 6 months and do your traditional cash out refinance. What this person is asking is there is a little loophole in Fannie Mae's guidelines where you can take a mortgage out from your LLC and bypass that 6-month seasoning by doing a rate and term refinance to pay off that mortgage. But you have to buy the property cash in your personal name to do that. So call me on that if you want some more details. I'm not going to go into all the intricacies on this because it can get a little bit confusing. But I would say if you're a new investor and you want to keep it simple,
just wait the 6 months.
Wait the 6 months. That's kind of more the traditional route anyway. But there is the option to do that, and if you want to kind of go down that path, for sure.
Well, Jared, this blew my mind when Jared first shared this with me. The whole point of real estate investing is ramping up. Very few folks buy a house and call it quits and put the rest in their 401k. They want to continue to keep the same amount of cash moving as often as possible. So obviously, speed kills. And the ability to do it ultra fast, and a lot of times, is what is paramount to a bunch of investors. So when Jared shared kind of this loophole that he identified personally with this Fannie Mae guidelines, essentially the way that it works is this: Evan Manship starts EMLLC, and EMLLC holds a mortgage for a property that Evan Manship buys in his personal name, cash. So I take money out of my wallet, I buy a house, EMLLC, which I own, takes a mortgage on the property. At that point, you're able to bypass the 6-month seasoning period, which Jared can talk to intricacies on a phone call maybe a little bit later. But it's not hugely cumbersome, but it is
it's pretty easy.
It's a real estate 201, maybe 301 conversation. You don't need to be an expert. You don't need 100 doors. You don't need some massive DTI or some massive net worth.
And I think the biggest thing to speak to that, and this really goes within almost probably any deal, is making sure you do your due diligence on what your appraised value is going to be. Because and this goes with any deal, right? You will either, that appraised value is going to make or break your deal.
100%.
So that's the biggest thing. I mean, I could probably talk an hour on making sure you do your due diligence on making sure appraisals come back good. But
that's the trickiest thing for a wholesaler and for a finance guy at the same time. We all want it to hit, but we need to make sure we're crossing our T's, dotting our I's on the back end before we even get hot and heavy in the deal. So, any questions about how to alleviate or completely avoid that 6-month seasoning period? There are a handful of folks that we see in here that are actively doing that who can speak to it as well.
Yep.
So call Jared. Again, Jared Shore, Finance of America, and we'll put his contact information in the comments below, so you can make sure you get a hold of him and bug him for the next 3 years. Okay, question number 3 here. How are loan terms and qualification requirements different refinancing a property owned in an LLC versus a personal name? Could you speak to that a little?
Yeah. So if it's owned in the LLC, and I'll kind of speak to this two different ways, because if you own it in the LLC, you can still do a conventional loan. You just have to close it in your personal name. So if you own it in the LLC and you want to keep it in the LLC, you got a 30-year refinance option. You can go up to 75% on 1 to 4 units. It's going to be more decisive on your LTV based on credit scores. More so than the property. So credit scores are going to have a little bit more of an impact on your LTV than just the loan itself or the property type if it's a multifamily. Well, read the question again, just so.
Sure. Dalton, you're putting these on the. I got my media guy Dalton here. I wish we had a reverse camera so you can see what I see here. Dalton's here, and he's displaying all these on the screen. So Jared's the only person that can't see these questions. How are loan terms and qualification requirements different refinancing a property owned in an LLC versus owned in one's personal
Got it.
name?
Okay. So I think one of the biggest differences we already spoke about is DTI, right? If it's in the LLC, we're doing commercial loans. It's 100% based on cash flow of the property versus a conventional loan, right? It's going to be DTI based and
Right.
personal income. The other big thing is your seasoning requirements. 6 months on both to do cash outs. You have the rate and term option on the conventional loan right now that you can do. You can do other terms on a conventional loan, so you can do a 15, 20, 25, 30. Obviously, most like the cash flow, right? So 30-year is the most popular one there. But probably the biggest difference if an LLC and you're wanting to refinance it into your personal name is if you are wanting to do a cash out refinance and the property's in your LLC, we can count the time that you own the property in your LLC as seasoning, except for if you're not majority owner. So, for example, if you're a 50-50 partnership, there's 4 people in an LLC, 25 equal, and you're wanting to do a cash out refinance conventionally, and just one of you is going to be on the loan, you have to deed that out of the property and wait 6 months from that time. Now,
It sounds like a horror story.
it's
Maybe
a horror
that would
story.
be-
Yeah.
up to you in the
So
making.
I will say on a rate and term refinance, that doesn't apply. But if you are trying to do cash out from an LLC to your personal name, you do have to be the majority owner of the LLC to be able to count your LLC as seasoning.
Got it.
So I hope that answered that question.
100%. I think for the beginners in the room, Jared throws around a lot of acronyms like I do at times for loan stuff. DTI is debt to income ratio. That's a ratio for essentially what you bring in on your W-2, your 9 to 5, versus how much debt you have. So for folks that have a new Corvette and $100,000 in student loans and finance their wife's fiance's engagement ring or something like that, you're probably not a good fit for a traditional conventional loan. But if you got a kick-ass property, the cash flow is like crazy. Commercial will probably be the best route
Yep.
for what you're doing. All right, next question, Dalton. We have something goes along the similar lines here, and this is there's a lot of parity between commercial loans and conventional loans, which is better in what
Yeah.
situation. This question reads: do you have advice using commercial loans for residential 1 to 4 unit properties if your DTI is too high?
Sweet. That's a big question.
We should say here before I get in trouble from someone, Jared nor myself are attorneys or tax advisors
Yes.
or anyone else important. So we might seem like we know what we're talking about. We probably don't. Please
Yeah.
don't listen to us.
I like that. So 1 to 4 units. Is there a difference between conventional and commercial?
Do you have advice using commercial loans for residential 1 to 4 unit properties if your DTI is too high?
Yeah, go commercial loan. If your DTI is too high, then you can't do a conventional loan.
So to use the same example, John Smith has $100,000 in student loans, has a new Corvette, has $20,000 on his fiance's awesome engagement ring. You're saying if you got a kick-ass property, if you
Yeah.
find something cool through Mainstay, buy it cash or hard money,
Yeah.
whatever, and refi using a commercial product.
Yep. Or you got to pay stuff down, right? If you don't want to go the commercial route, which I should say, you can close loans in a commercial loan in your personal name or an LLC. So you have that option even if you don't have an LLC. But yeah, if your DTI is too high, I mean, you've got a couple options, right? You got to go make more money, right? Or pay down.
There you go, folks. Make
right?
more money.
Yeah,
That's
make
why
more
we're
money, or pay down some debt, or we can also use the income from that property. So if it's the property itself that's causing you to not qualify, if you're buying the property, or in this case probably they're refinancing, right?
Yep.
Would be my assumption.
That's what it looks like.
If you have renters in that property and you have not filed tax returns on that yet, so let's say you bought this property in January, you're refinancing it in June, you don't have taxes on this, right? Well, we can use 75% of your leases as income. So sometimes that can help, right? We can use the property income to count for
Yeah, to offset
total
some of the DTI
income.
or whatever.
Exactly.
But at the end of the day, it appears like the more universally accepted method if your DTI is wildly off the charts, like
100%.
mine was when I was 24.
Yep.
Commercial is probably the better way to go, just so you can ramp up
Yep.
a little more quickly. Dalton is doing a weird wave, like the wacky waving inflatable inflating tube guy in the back. He's got a question. What we got?
Question from, or maybe more context from Stephen Burden. Says, I've heard you can put a lien on it with a family member instead of doing it with an LLC. Have you heard of doing it that way?
It's the exact same thing.
To repeat the question real quick to make sure everyone heard it from Dalton, shouting from the peanut gallery. Stephen, that's an awesome question, man. Stephen asked, he's heard of doing it, essentially the get around for the seasoning period, to be taking that lien and putting it on your property with a family member. So myself and my wife, or myself and my brother, putting a lien on a property that I own personally. Is there a way around doing it something like that?
There is. I mean, so let me go back to and talk about what the lien actually does, right? And why the lien's important is because the lien is giving us a tool for something to pay off, right? Without a lien on the property, it has to be considered a cash out refinance, right? So now you have to wait, and that's where you have to hit the 6 month seasoning.
So that's the workaround, is we've got something to pay off.
You got to have something to pay off, right? So in that scenario, if the money's coming from a family member, there's nothing to say that family member can't put a lien on that property, right? And it does need to be a mortgage that's recorded. So that family member, by all means, have them put a mortgage on the property.
So
And it'll be the same exact thing. We're just ordering our payoffs from the family member,
got it.
whoever the lien holder is.
So then that payoff that they send to you, you don't care what it is, why it is, how it is, as long as the appraisal makes sense. So
most part.
if you're all in for a property for 70 that's worth 100, that appraisal comes back at 100. Even though you're all in for 70, you're not getting 75% of 70. You're getting 75% of what that's worth to
Right,
pay
exactly,
off the 70. Got
100%.
it. Makes all the sense in the world. Thank you for the question, Stephen.
Yep.
Dalton's waving at me again. What we got?
Phil Kim, he's just adding on. He says, shout out to DA Rate and Turn.
I don't know what that is. So that's a Jared question.
I should point out, Phil's the brainchild behind this whole thing. Anyway, it was his idea. We were the first ones. Him and I were the first ones to do this loan. So, yeah, he's the one that brought it to me, and we kind of did the research on it on our end, and yeah, we've been rolling since. So
We just
shout out to Phil.
Shout out to Phil. We just finished up a duplex for Phil, and I'm assuming that'll go the same way. It's the one on Tuxedo. Let me know how that thing goes. It'd be a cool case study on making this thing happen. Congrats on the success, Phil. Dalton continues to wave. What's up?
We got one from Clay Manship asking, Jared Shore, does the bank/Fannie/Freddie ever get fishy if they realize the LLC is associated with the borrower?
Man, that's actually probably that's probably the best question on this ad. So Freddie, we've not gone down the road with Freddie, but I can tell you Fannie is much more investor friendly than Freddie is, and I'll point out a reason why here in a second. We went all the way to to Fannie and asked the question, is this an acceptable structure?
Oh, so you talked to them directly?
We talked to them directly, and not only did we talk to them, actually our head underwriter for Finance America nationally went to Fannie after this went kind of through the pipeline.
No kidding.
And so we got the double thumbs up from Fannie that says this is an acceptable structure because it is a separate entity, right? If it was you putting a lien on your own property to yourself, obviously that wouldn't make sense. But because it's a separate entity, then you're golden. I should point out, one of the biggest questions I get a lot around LLCs and conventional loans is, can I deed my property back to my LLC after I refinance it or purchase it in my personal name if I'm doing a conventional loan? Mm-hmm. Freddie, hard no. That they do not allow that.
That seems par for the course for them. Yeah.
Fannie, and I don't know when they changed this, but we actually looked it up yesterday again to confirm. It's part of their exceptions. You can actually transfer out of your personal name into your LLC with no penalties, again, as long as you're the majority owner of the LLC.
No due on sale clause?
No due on sale. It's one of the exceptions.
So just to be clear, folks, what Jared is saying is Evan Manship buys a property in his personal name, cash. Simultaneous at closing records a mortgage, EMLLC, against the property. We go through, at that point, we're no longer bound by the seasoning requirements of 6 months. So the loan comes, I take the loan in my personal name, cool, I cash out my LLC, get all my money back in a month, 2 months, whenever it's all done, could be 3 weeks for all anyone cares. We get the money back, and then once it's all done and the loan is through Finance of America, whatever bank, Fannie, and Evan Manship, I can quit claim Evan Manship's property to EMLLC free of charge, free of due on sale clause, free of
Yep.
anything, which is the ideal situation for investors.
Yep.
You get a maximum loan term, maximizing your cash flow. You're out of your personal name, which protects you personally, and you're not bound by the seasoning requirements of 6 months, meaning you can do it again and again and
Yep.
again and again. So
The
that's
mortgage
huge,
the mortgage will still remain in your name, in your personal name, but the asset is now protected. From
which is
the
the whole
LLC.
point.
Right,
Yeah, that's
exactly.
huge. That's
Yep.
huge. Dalton's waving again. What we got?
We got 2 more questions. One from Scott Sharon.
Scott Sharon from
Scott Sharon.
Delaware. What's up, man?
Scott asks, how do interest rates compare in general for a rate and term refinance, a cash out refinance, and a traditional mortgage? So how do interest rates compare for a rate and term refinance, a cash out refinance, and a traditional mortgage? Looking to get precise on my underwriting.
He wants down to the bit, baby.
Man.
Yeah.
So, Scott, good question. Good to hear from you, man. So the question was, how do rates compare, both rate and term, cash out, more conventional mortgages? Rate and term refinances, you're going to get a better rate. Cash out refinances are always going to be kind of your worst rate structure in any mortgage related, I guess mortgage, I guess. Yeah. So I don't have a great answer for you because every property, every person's a little bit different, right? There are a ton of different factors that go into your rate. So you've got credit scores, you've got loan level pricing adjustments, which again, we could talk an hour about loan level pricing adjustments,
We started to
which
already.
we started to earlier, man. There's some crazy things going on in the market right now. You've got the type of loan that you're doing, cash out, rate, term. You've got the property itself. Is it a 1 unit? Is it 2 unit? 4 unit? Is it an investment property versus a primary residence? So all those factors, it's risk layering, right? So your rate and term refinances, if you want a number, I'll say, let's call it 1/4 to 0.5% better. Like, don't quote me on that, but that's general rule of thumb. Probably 1/4 to 0.5% better. Cash outs are going to be a little bit higher, and then when you go to the the commercial side, kind of the same concept, but just add a little bit on those as well. So your commercial loans typically are higher than conventional loans. So
It's nice to finally have a non-political answer and finally gets like some objective
Yeah.
numbers put to it. So thank you for that. Dalton's got one more. It looks like you're a wild man.
We're going.
You're an absolute. I'm gonna get a refill here in a second. You're a wild man.
So
Hit me.
here's what we got. Dave Blackman he's got a question, and then also Phil Kim added on to Dave's comment. It looks like we're going back to some of the Fannie Freddie talk.
Yeah.
Okay? So here's where it's at. Dave Blackman asks, what are your thoughts on recent news about the 7% max investor loans with Fannie per lender portfolio, and what that means for rates, etc., on conventional second/investment prop
Yeah.
loans and/or commercial loans? Hold that thought. Phil then says, to add on to Dave's comment, do you think since Fannie and Freddie didn't give a huge heads up on this, that we might see other guidelines come down the pipeline?
yeah. So
this is something I didn't know about personally until maybe an hour ago
yeah.
or something.
Well, and to be fair, we didn't know about it until late last night today.
So this is breaking
This is breaking news.
development in the finance world.
So, and just to make sure everybody heard, the question was about there's some new regulations, if you will, that Fannie and Freddie are putting on, and I'll explain it to the best of my knowledge that I know of right now.
and maybe how it trickles down to
Yeah.
whatever, because people are going to think, well, I'm working with Finance of America. Why do I
Right.
care about Fannie?
Right. So Fannie and Freddie have announced, like I said, literally within the last 24, 48 hours, that they're limiting their exposure on what they're buying to no more than 7% of what they're gonna buy. Their total portfolio, if you will, is going to be non-owner occupied. So that's investment properties, second homes, vacation properties, anything that you're not living in. They're going to limit their exposure to 7%. So, and that's about as much as I know about it. It's really about as much as the lenders know about it right now. And so there's a lot of uncertainty. So yes, to answer your question, I think there's going to be a lot of guidelines come out that we just don't know about yet. But what has happened is, because there's so much uncertainty around what this means to lenders, is lenders right now are they're basically pricing themselves out of the market because they don't want to take these loans on right now. So we were reading an article from, I think it was Housing Wire, that some lenders are putting up to 600 bips fees on their rates right now, just to
For the non-scholars in the room, 600 base or 600
6%.
6% on top of your loan. So we're seeing things right now. It's the equivalent of and we have our attorneys and our tax guys working on this right now to get some more answers on what this means for investors. But again, we just read the article together at Jared's desk, and we're seeing, again, there's this Housing Wire, whatever the hell it was, 600 basis points in addition
to put that in perspective. If it's $100,000 loan, that's $6,000 extra in fees just to get your rate.
Which is obviously it's similar to the business.
Now I should point out we are not doing that.
Finance of America, no,
we are not doing that. We did raise them a little bit, but not anywhere close to that.
Lenders are positioning themselves for additional risk being taken, and it's the equivalent of a really good contractor being extremely busy, and he'll go bid your project, but it's going to go through the roof, because if you pick him, good for him. He's going to get some wildly overpriced project.
And they're pricing these out right now because what they don't want to do is, as a lender, you don't want to do this loan, fund this loan, and then Fannie Mae doesn't buy it, and now you're stuck with this loan that you have to service now with no out. It's probably a good segue into how lenders really work, right? Lenders they essentially use the Burr method. Right, they're using giant warehouse lines of credit, right? And when we fund a loan, we're funding it with a line of credit, and Fannie and Freddie are buying this loan as an investor, essentially, off of our line of credit to provide us with more liquidity to go do this. So if we have all these loans on this line of credit, right, that they're not buying, that limits how much business we can do.
Yeah, and it's the equivalent of someone getting hooked on a hard money loan and having no person to refinance out the deal. It's bad news.
Especially if you have smaller banks that have smaller lines of credit to do this with, they're probably the ones that are going to price themselves out of the market because they don't have as much liquidity to play with. So. Yeah, that's like Mortgage 501 there for you.
Mortgage 501, thank you, Jared. And just for the beginners in the room, would you mind kind of who's this Fannie person, who's this Freddie person we keep hearing about, and why the hell do we care about them?
Yeah, so
real brief.
Yeah, they provide liquidity. I mean, that's the biggest probably piece and importance that they provide in the market to lenders is they provide liquidity by buying loans, and it gets really complicated on the back end, but they're GSEs are government entities that basically monitor and they set the guidelines. So they're the ones that we have to follow all the loopholes that you guys have to jump through, to provide us documents. Like, that's not us. That's Fannie and Freddie. So
quasi-government agencies that buy the paper that Jared originates.
Yep.
So Phil Kim, when he brings 1100 tuxedo to Jared says, "Cool, here's your money." Cool. Immediately takes that paper, sells it to Fannie and Freddie, so that he can go back and make more loans and keep the machine moving. So,
there will be a lot more information coming out on that in the near future for sure. But for right now, there's just a lot of unknowns, and I think what you're going to see immediately over the next couple weeks is rates going up and down and up and down, especially with the investors. They're just going to be all over the place until we find out exactly what this means and until it levels out. But I think the biggest thing is you're going to see is rates are going to go up, and I think what it doesn't affect is your commercial and non-QM stuff. So
QM, I'm sorry.
Non-QM. So QM being Fannie, Freddie.
There it is.
your qualified mortgage, if you will. Non-QM being all your commercial stuff, your bank statement loans, all the things that don't have to follow those guidelines set by Fannie, Freddie. So I think those are going to be a little bit more prominent, especially in the near future and maybe long term as well.
Yeah. So. And again, everything depends on your background, your scenario, your property, your financial situation. But what Jared is saying is volatility is bad for investors. Uncertainty is bad. And right now, the one thing that's uncertain is Fannie and Freddie mortgages that they're in the process of acquiring. So if we can completely alleviate them from the scenario and say, hey, I'm going to do a commercial loan. It might cost a little bit up front, but there's going to be zero fluctuation of what your expectations are. So to Scott's question, I want to be more accurate in my underwriting. It might make sense as a worst case scenario to underwrite it with a commercial rate so that you can have some more understanding on what that looks like.
And heck, I haven't looked at it, but commercial rates may end up being better than conventional loans right now. Who knows? I mean, it's nuts.
World's gone mad.
Yeah.
Did you have another question?
So we've got 4 in the can over here, but if you want to do one that's written already, the people that tuned into or that filled out the form, I think we can get to one of those and then come back.
Well, I've got one here that kind of came up last second. Actually, a woman in our office today, an investor in California, asked something similar. And shout out to Renee for coming by and saying hello. Essentially, she was asking about different markets. Mainstay is now in Louisville. just because Indy is wildly competitive. We're still here. We'll do 20, 30 deals a month or something along those lines. But people are looking for new opportunities. And so she asked me, full transparency, have you heard about, what things are like in Louisville from a refinance perspective, from an appraisal perspective? She mentioned Richmond, Indiana, and Dayton, Ohio, and of all places, Terre Haute, which apparently is a place where people are spending their money now. So
Doing a lot of refinances in Terre Haute.
You and I talked a little bit about Terre Haute. I mean, what's the story like with that market and appraisals there and all that jazz?
It's hit or miss. The newer markets, I think the biggest, it's just, they're just, again, it goes back to unknowns. Anytime you don't have, a solid, Indianapolis, you can pretty much nail it down to a penny almost, right? For the most part of what a property is going to appraise for. And some of these newer markets where it's just not tapped yet, there's just a lot of volatility with appraisals. So that's the biggest thing we've seen, especially in some of these newer markets, smaller markets, is they're just not the comparables.
Not enough volume.
Not enough volume yet. It's going to be there. So it's just not a guarantee yet.
Yeah.
So, yeah, it's for you guys that are doing that. I love it. I love that you guys are going and kind of tapping that market to begin with. But yeah,
it's always neat to see folks pursue other markets, and especially small ones that are unproven. Godspeed to everyone out there doing it. But for full transparency, I respect the hell out of it, and I think it takes one to be 2, to be 4, to be 16. So keep us posted if you're identifying other markets or tired of getting outpriced in Indy. Louisville's certainly a place for you. We had like 3 or 5 more minutes here, Dalton. So why don't we hear a couple more deals here before we get out of here?
Yeah, sure. So we got one from a little while back from Steve Wayne. I'm not
Mr.
sure
Steve.
exactly what he was talking about. He said, great strategy. By the way, I did the private mortgage with my LLC 5 times last year in Indy, so I can attest that it works like a charm. This was maybe 15, 20 minutes ago.
Cool.
So here's his question.
So basically, Steve is validating that the loophole loan works.
And then here's his question. He says, I'm at 10 conventional loans now. I want to move a few of the cheaper houses ranging from 175 to 210 into portfolio commercial loans so I can free up slots for conventional loans. What should I look for in commercial/portfolio loans?
Ooh, man. So what you should look for, one, I would maybe wait, right? Because I don't know, again, whatever this whole thing with Fannie Freddie, I mean, if that's going to prevent you from potentially getting other properties in your conventional names, you free up those 10 spots and all of a sudden the rates are just garbage, right? Like maybe it doesn't make sense to spend the money to move those over from a closing cost perspective. But I think the biggest things you want to look for in portfolios is what kind of loan to value can you get? What kind of terms? Can you go long term? Most of the portfolios that I've seen out there are shorter terms, interest only, kind of balloon payment styles.
What do you see from a term perspective? What is short term?
Short term, like for example, we have several options, like a 5-year interest only with a balloon, for example.
A balloon after 5.
A balloon's after 5. Depending on your strategy, maybe a great cash flow option.
Yeah.
I think one of the unique things about our portfolio loans is we offer a 30-year fixed on a portfolio. I think another cool strategy with portfolios that you may want to look at is cross-collateralizing, meaning you can take those properties, refinance them, and purchase properties all in the same loan. So if you have some bigger, some apartment complexes you want to take down, use your refinances, use the cash from that, and essentially you can almost walk away with maybe nothing out of pocket on those too. So
Jared has bigger, brighter ideas than I do. And Steve, you don't need to told this, but something I just mess with personally when I refinanced a couple of my apartments. I got hit pretty badly with a prepayment penalty. It wasn't structured the right way up front. I was young and dumb and said apartments and didn't look too much into what that looked like. It was a 7-year step down.
Yep.
And of course, with 3 years remaining, that's still a big bullet to bite.
Sure.
At the end of the day. So I'd encourage you that if and when you look into Jared's products or other products on a portfolio or commercial refi, that you really hone in on the prepayment penalty and do what you can, even if it means paying another point or two to just completely alleviate that. It makes a ton more sense if you can plan on refining and rates are going to stay low.
And I think, again, depending on what the market does, I mean, it feels like there's this shift that's going on, that they're trying to push investment loans out of the conventional world and going more towards the commercial non-QM world. So if you can keep your low rates on your conventional loans, leave them there.
Yeah, leave them.
But
Leave 'em forever.
that's, again, everybody's situation is a little different, so I have no idea what your portfolio looks like. But that would be my advice for right now. Just wait for a second.
Cool.
Floyd wants to know what you guys are drinking
Ah,
and if you're going to get any more.
Floyd.
Floyd, if we had it our way, we'd have plenty more.
We started out with a little Blanton's and we went to a little Weller after. So yeah, we're drinking some good stuff today.
I tell everyone the same thing. I'm going to keep talking about Louisville, but it's funny going from Indy to Louisville, where Indy's bourbon collection is like these two bottles. Then you get to like Northern Kentucky or anywhere in Louisville or Frankfurt or anywhere like that, Lexington, and it's just a big, massive wall. So I walked in and thought for sure I was in Northern Kentucky just now. But
If any of you guys ever get to Indy, especially out of staters, we'd love to have you let's have a little networking thing right here. Let's drink some bourbon.
Dalton will put some B-roll footage in the office. Jared has a kick-ass spot here where we could have probably the best meetup of all time. So if and when, maybe the third annual Indie Investor Symposium in November, we'll bring everybody up and let Jared get up there on the stage and preach to everybody. But until then, we'll be drinking Blanton's here at Jared's spot.
We got two good questions here that are still following on the loophole for the most part. So the first one's from Bailey Mason. He asks, how exactly does the LLC mortgage get recorded from personal name at closing for the loophole?
So the first trick is you have to purchase the home in cash in your personal name. That's step one. It doesn't work outside of that. I don't want to speak too much into how it needs to be recorded because I'm not a real estate attorney again, but I can tell you, and this is not a plug, I know one title company that is helping, Monument Title. They have a form you can fill out and they will actually create the mortgage for you and record it for you. So just get with a title company.
It comes from someone who's done this dozens of times. It costs $312 to have that recorded. So to have that made and put in your LLC and all this other stuff, boom, recorded, done exactly the way it needs done because it's happened. $312, at least it was $312 maybe a month ago. So if you just tell Monument what you're doing, they should know exactly what's happening. It's very, very easy to structure.
Yep.
Okay, then next question, not to beat a dead horse, this is from Scott again, not to beat a dead horse, but are there any negative drawbacks you guys would warn against for rate and term?
Just in general? So any drawbacks to rate and term, I think it goes back to figuring out what your strategy is on particular property. I mean, rate and term, I'm assuming he may be talking about the recording a mortgage on your, from an LLC. I can't speak to taxes, what that does from a tax perspective because, the check is going to the LLC, right? So talk to your CPA about that. I have no idea, but no, the benefits are you're getting a lower interest rate. You can, if you have a 2 to 4 unit, if you have a duplex, triplex, quad, you can go up to 75% on these versus a cash out. You're going to be limited to 70% on multifamily. So you get 5% extra LTV, using the rate and term versus cash out, and you're going to get a little bit better of an interest rate. So I don't see any negatives to it, other as long as you structure it correctly.
And structuring it correctly is the biggest piece of it. And again, to make everyone happy, we're not attorneys, we're not CPAs, we're not tax advisors. Go talk to people smarter than we are. But that being said, I have a handful of these case studies that I can share with you that Mainstay's handled from start to finish. We have the loan documents in Word form, PDF, whatever you want to see. I can send those to you, no questions asked. But the whole point, the whole reason I wanted to introduce Jared to those very few of you that don't know who he is this is something that I think that everyone needs to be taking advantage of who has any level of relative sophistication with real estate investing. There's not a reason shy of $312 that you shouldn't be exercising on your ability to achieve more quick turnarounds with your deals here. So. Dalton, are we good? Are we fished out of the barrel finally?
We had one more from Clay, if you want to take it.
Bring it on.
Clay asked where you guys stand on the Blanton's versus Basil Hayden's debate. And John May quickly followed up saying Basil Hayden's is toilet water compared to Blanton's. Now for price and availability, I'll hang up.
my take is this. Blanton's is good. It's overrated. If you get Blanton's Gold, it's pretty darn, much better. And if you get Blanton's straight from the barrel, it's the best.
Guys, we're going to go drink another Blanton straight from the barrel here. Jared Shore, truth bombs for everybody. Thanks for having me, man.
Yeah.
Appreciate it very much. Like, follow, share, invest at mainstaypropertygroup.com if you have any questions, comments, concerns, and we'll put Jared's contact information in the comments below. Thanks for having us, guys. Talk to you all soon.
Guys.